The new updated 3-fund portfolio is taking over the world and is by far one of the strongest performing ways to invest in 2024. I have multiple videos explaining this more in depth, and I'll link to that in the description below and queue it up to play after this video ends for those of you who don't already invest in this. This style of investing gives you stability and history of funds like the S&P 500 or the total US stock market investing, alongside the possible growth potential and upside of purely AI and technology sectors, while also giving you much safety in the form of cash flow, while providing a larger dividend than that of the S&P 500 to give you cash even if the portfolio drops in value due to a slight market downturn. Many people recognize that this is a very strong way to invest, but inevitably I get the question, how do I invest in these 3 funds? Specifically when we're talking about different types of investing accounts, such as the 401k versus a Roth IRA versus a taxable brokerage account. This is precisely the question to be asking, so good job. You guys must be listening and taking notes in class, which makes this Professor Hart very happy. I'm Nolan Gouveia, and I made this channel to make investing simplified. So let's simplify this question. Now there's a couple of main reasons for this question. The first surrounds the idea of taxes, and the second surrounds this idea of time or strategy. But before we get to that, let me just remind you what each of these 3 funds do, because if you understand that, then you'll understand why we get to where we get to by the end of this video. Because without understanding that, none of this is gonna make sense. So the first fund in the 3-fund portfolio is foundational. This is called foundational because it's like when you build your house and you want it to be on something solid. Same thing is true in investing in stocks or in the stock market. You want something that's been tried and true, been around for a while, has a lot of history, seen ups and downs, but consistently goes up long term. And that would be things like the S&P 500, like SPY, or VOO, or SPLG. Or you could go with the total US stock market index, like VTI from Vanguard. The next one is this growth style, and this one's super exciting, the one that everybody's talking about now with companies like Nvidia or Tesla or Meta or Amazon. This one's definitely the one that's going to shoot up the most, but it does have the most amount of volatility, so you do want to keep that in mind. This would be ones like QQQ or QQQM, or SCHG from Charles Schwab, or VUG from Vanguard. Last would be a dividend type fund or a cash flow type producing fund, ones like SCHD from Charles Schwab, or VYM from Vanguard, or even JEPI, J-E-P-I. Now the dividend fund is great for when you're retired or when you want to start living off of this dividend income as passive income. It's great because it's producing an income every single month or quarter, and it makes it so that you don't have to sell your shares in order to reap the benefits. The problem is that if this type of an account or stock is in a taxable brokerage, you have to pay taxes on the dividend even if you just reinvest the dividend straight back into the fund and never see that money while it's building up. This video isn't about which category is best, or you really like one or all of those ETFs that I just talked about. Throw that down in the comment section below so that others can learn about what you think might be best. So now that we understand each one of these funds, now we need to understand each of the investing accounts that are in question. And the first is a 401k and also the traditional or simple IRA. This account is purely for retirement, so anything you invest in it can't be taken out without a penalty until after age 59 and a half. The advantage for this account is that you don't get taxed on the money that goes in right now, but later on when you do withdraw, you're gonna be taxed at that point. The next account is a retirement account as well, but it's almost exactly opposite to that of the 401k or the traditional IRA. And this one is the Roth IRA. You still shouldn't take the money out until after age 59 and a half, but any money that you put in now gets taxed ahead of time or right now, and then it gets to grow tax-free, and anything you withdraw at retirement age is totally tax-free. So anything it's grown to with all that compound interest, totally tax-free. Another big pro about the Roth IRA that a lot of people don't know or don't talk about is that you can actually take out any of the money that you do put into the Roth IRA since it was already taxed up front. So anything that you allocated, you can take out of the Roth IRA if you want to. You just can't take anything that it's grown to or the dividends or anything like that until after 59.5. Now, you shouldn't be taking money out of your retirement account. You should try to let it sit there and grow, because the bigger that it is, the more compound interest that could happen for you. And the last account here is that taxable brokerage. This one is not a retirement account, which is very important to understand, which means that you can put money in and take it out at any time without a penalty. The issue with this one is that, first of all, any money that gets put in doesn't get a tax advantage at all. Secondly, if you were to buy a stock for $50 and it goes up to $75, that gain of $25 will be taxed when you sell the stock and take out the money. We're all investing in order to make our money grow, and so we want to make sure and invest in the right types of funds and the right types of accounts. In a second, I'll explain exactly which funds go where and exactly how much as far as percentage of each of the 3 ETF categories to go within whichever type of account. Let's start with the Roth IRA, which was that second one that I discussed earlier. This one is the easiest for you to pick what and how to invest because you've already been taxed. There's no more taxes no matter what you invest in, no matter what. Now, most invest high dividend here because in other accounts, you're taxed on those dividends as you get them. But within the Roth IRA, like I said, once you've been taxed once, you're never taxed again. For most, I've seen it work best if you invest 1/3 of the total account in each one of those 3 funds for the 3-fund portfolio. Just because, yes, dividends is the ultimate hack, especially within the Roth when you retire. But for now, we do want that potential of the higher growth so that price appreciation can happen as well. So we do want the power of those other 2 funds to make it that 3-fund portfolio. Next, let's stick with the other retirement accounts, which would be that 401k or the simpler traditional IRA. This one's a little tricky because you will be taxed on whatever you withdraw later on. Keep in mind that you're not taxed at all while it's growing though. So even if you invest in dividend style funds, or if you invest in a certain company or ETF and it grows a bunch, you're not taxed while it's growing. Specifically in a 401k or a 403b like I have at my university, you need to watch out for the fees. In my 403b specifically, the fees are really high for those really specialty style funds, things like the target date funds or even the growth funds. And so for me personally, I really like to pick the S&P 500 because for that one actually has the lowest fee out of anything else that I could pick. Obviously, you should be picking what you think is best for your investing strategy, but consider the taxes later and the fees now and later in your decision. Lastly would be the brokerage, and this is definitely the most complicated and individualized based on the individual and specific needs of that person. I'll tell you what to be mindful of, and then afterwards I'm going to explain exactly how I'm investing within each one of my 3 accounts. Now, with a brokerage account, the biggest thing is no surprise, and that's the taxes. Specifically with dividends, but also with price appreciation eventually. So specifically as it pertains to dividends, remember that you're going to be taxed on the dividend no matter what. Even if you're reinvesting that dividend directly right back into the fund and you never actually see the dividend or use the dividend, you're still being taxed on that at the end of the year. So the funds to be cognizant of this would be ones like SCHD, VYM, JEPI, and those types. As far as share price appreciation, you still have to understand that later on, the only way that you're actually going to see any money, that you're going to make money, is when you sell the share. Say you bought the share at $200 and it went up to $1,000. That's amazing, but the only way that you're actually going to see the money is if you sell that share. So when you do sell that share and you did make an $800 gain, you're going to be taxed on that $800. These types of funds to look out for or just be cognizant of would be the growth funds. Things like SCHG, VUG, VGT, any of those ones that have high growth. Specifically nowadays would be things like high technology, high AI, and semiconductors. So how do I invest in my brokerage account versus my retirement accounts? First off, I'm 35, I have multiple streams of revenue, I have a fully funded emergency fund of at least 6 months of living expenses, and I have other assets such as rental properties and businesses that are able to bring in cash flow, but also that might be a little bit riskier. And so I have to keep all of this in mind when I'm thinking about how I'm going to invest specifically. I personally just stick to 33% in each one of these 3 categories for my brokerage account. I'm fine paying the taxes as I go on the dividend style funds because it's not that crazy right now, and I like the dividend growth that I'm receiving, so my yield on cost is very, very nice. It would also be crazy for me not to want to take advantage of the growth sector because right now that thing is going crazy, so that's why I have about 33% in each one. Within my retirement accounts, I do it very, very similarly. Like I said before, in my 401k or really 403b, I stick to 100% the S&P 500 because the fees are the lowest there. But then in my Roth IRA and my traditional IRA and anything that's outside the 403b, I invest purely in my dividend fund and my growth fund at 50-50 there. So I'm getting the full amount of foundational in my 403b, then split it 50-50 with growth and dividends in the other retirement accounts, which makes it about 33% in all of my retirement. As I get older, I'll rebalance and I'll make the dividend category bigger, but for me, at this age and my risk profile, this works very well for me. To learn more about the 3-fund portfolio and get started, watch this video now, or watch this video to keep you going strong in your investing journey.